that's what we're going to be talking about today. So, of course, we're going to be looking at the economic calendar, right? Just having a brief look into the economic calendar. If you haven't yet had time to go into the YouTube and then go into the ACY Securities website, channel. I've done a video yesterday on, the week ahead, as usually we do. I will send the link on the chat. Let me just find the chat. There we go here. The week ahead video. I do this video every Monday, so you guys don't miss anything off the economic calendar. But we're going to be talking today again with the economic calendar. For those who haven't watched the video, we're going to be talking about the Federal Reserve rate cut decision, as we saw, okay, by 25 basis point cut, and do some sort of understanding about it, because the inflation remains very high, very elevated, not very, very high as it was before, but it's still in somewhat elevated. So I want to make sure that you guys understand what the Federal Reserve is actually doing. Then we're going to be talking about the impact of fiscal stimulus on US dollar and how this can, be tradable on the euro dollar. I'm using euro dollar. Okay, I will explain why I'm using euro dollar and any other pairs like GBP USD or USD JPY. But mainly because it's one of the big majors currencies. We have euro, that is a very, very simple forecasting sort of pair that we can model ourselves into it, and we're not going to have surprises from ECB. So we need to try to find safer. We need to try to find safer but risk as well, that we can sort of combine our risk management and get some good returns out of it. And I think Eurodollar is one of the potential ones. Then, trading strategies for Eurodollar. And last but not least, will gold bounce back? And when will gold bounce back? All right. I think there's a type error here. Let me just check now. Bounce back or bounce back? Bounce back is formed with English by compounding. Yeah, that's correct. Bounce back is correct. I thought it was going to be wrong. But anyways, so before we start, let's just go through the risk disclaimer, give it a minute so everyone can read. You already know, and then we start. All right, perfect. Let's move ahead. Just get out of this. Oopsie. Why is it not going out? Oh, perfect. There we go. Let me just put it here. All right, first topic, economic calendar. Let's go for this week. And I'm using FinLogic's economic calendar. Very, very easy to use. The way you can get there, just type finlogics.com on Google, and you're going to get to this website. Then you come to tools on your top left corner, go into economic calendar, and there you are. For those who maybe are on the, tablet or maybe not on the computer, I will send the link on the chat. So economic calendar, and you guys can use it as well, right? Just click in it and you will be open this page. Once you're in that page, I will be looking to all countries. And then I will be selecting only the medium to high volatility, because low impact, it's pretty much, this is the lowest of the lowest impacts that could be happening on the market at especially this moment after election, and a Fed just cutting 25 basis point rate, and all the big things are happening. I think the lowest impact is really, really the lowest as it can get. So let's only look at high and medium impact. So for Monday, we didn't have anything. All right. We only have something. We only having some things today. So we had 10:30 this morning, Australian NAB business confidence coming higher than expected at 5 than the forecast at 2. And the Westpac consumer confidence came in at 5.3 from the expected negative 0.8%. So that's a really, really big change from for the month of November. And that's pretty good for the Australian dollar as well. It shows that the consumers are confident that the money is actually worth what it is. So they are worth that the $100 bill is worth $100 and that the 50 cents is worth 50 cents and etc. I still have my doubts to be very honest with everyone, because as we live in Australia, I don't feel like $100 is $100. I feel like $100 maybe 70. All right. So unfortunately, it is what it is. But let's get into the point. At 6 p.m. today, we're going to have German inflation rate month over month, as well as the year over year. That's the final. Okay, final don't have much influence. The flash and the final don't have much influence into the market, but it's always good to pay attention to those types of releases. They are expected to be a little increase from the previous. Okay, for previous was 0% for month over month, and now is expected to be 0.4%. The year over year is expected to be 2% from the previous 1.6%. And moving ahead, we're going to have as well at 9 p.m. Germany Zero Economic Sentiment Index for the month of November. Forecast 12.8 from the previous 13.1, so declining. But it is what it is. Yes. Then moving to Wednesday, we won't have much, right? We only have France unemployment rate. We have a lot of speeches from the Fed. So you know, I don't think they will do something. Yes, it's always important, and we can always get some hints over what can potentially, bring what can Jerome Powell potentially bring us in the next meeting on December. But in overall, I don't really see much volatility of those types of people. Sorry, we don't. Yeah, on the 18th of December, I think it's the 18th of December. We're gonna have a look on later. Let me check. Yeah, 18th of December. So I don't think this will bring much volatility. All right, but still, it's always good. It's always a hint on what they want to talk to us. On Thursday, that's where some sort of volatility will kick in into the US dollar. Most likely, we will see inflation being as expected or a little bit higher for the year over year. And as we can see here, the forecasting is 0.2% from 0.2% for the month of the month. For the core inflation month over month is expected to be 0.3% from the previous 0.3%. The core inflation year over year, 3.3 from previous 3.3. And the inflation rate year over year, 2.6 from 2.4. So 0.2% higher than what it was previously. That's what they are expecting. Okay. Moving on, we have Australian unemployment and employment changes. And then we're going to have employment change as well as GDP growth rate quarter over quarter, second estimated. Okay, so that's not very, very important. Still important, but not that important. On Friday, PPI, so the producer price index for USA, that's very important, 0.2% from the previous of 0. So if that comes actually higher than 0.2%, this will continue to show a lot of strength to the US dollar, okay? Then at 7 a.m. on Friday, and we're going to have the Fed Chair Powell speech, and this will definitely bring some insights to us on what they will be doing on the 18th of December, okay? Moving ahead, GDP from Japan, bringing some volatility, expected to have a contraction of 0.6%. So from 0.8% previously, now expected to be 0.2%. As you know, Japanese yen is very, very weak already. So maybe we will continue to see even weaker Japanese yen, and this will probably drag US dollar JPY even higher. Okay. Then China retail sales and China industrial production, this will definitely bring some volatility to Australian market as well. As we all know, China is a big partner with Australia, and Australia is a big partner with China. So whatever happens on Australia and whatever happens um, on um, on on China will affect both countries. Okay. Then moving on, we have United Kingdom GDP expected to be same, no changes for the month of a month. Wholesale prices, not much happening. And then on Saturday, just for the morning of, midnight of Saturday, we have retail sales month over month for the month of October for USA, expected to have a contraction of 0.1% from the previous. So previously was 0.4% and now is at 0.3%. That looks pretty much it. Oh, yeah, well, I forgot to mention one thing. The retail sales can definitely indicate to us some sort of volatility being higher or lower, okay? Why? Because if the retail sales gets to higher points, that is pretty much showing to us that the consumer confidence is high and that they are spending money and they are not leaving the money into the pretty much the savings account as the central bank would like to. Okay, so that's the only thing here. Yeah, any questions regarding the economic calendar, or can we move on? Just let me know, guys. I think that looks pretty clear, right? Now, let's talk about the Federal Reserve rate cut decision. Let's get into the Fed website. Okay, I will send this to everyone. Fed website. It's right now at the chat of our meeting. You can scroll down all the way to November and you can click on HTML and this will open the page for us on the November of 7, 2024, where the Fed has done the decision. Okay. Right. So there are some things that we may talk here. I've read it already, so I'm just gonna talk to everyone so you guys can read if you feel like. But I'm expecting they are expecting some economic growth, and this will boost the US dollar demand, as well as will occasionate, if we look to a more economic perspective, once we have a demand for the US dollar, this will generate some pressure to the euro dollar, as the US dollar will strengthen. And of course, we're going to be having the US dollar divergence against Eurozone economic area and etc. So the impact of the fiscal stimulus on the US dollar will be pretty notable. Okay. Now they've just on the first header here, we can see that the recent indicators suggest that economic activity has continued to expand at a solid pace. So that's pretty good as it gets. But as I say, once we have higher and higher GDP, we're pretty much showing that if the economy is growing. And if the economy is growing, then people are more tend to go for US dollars and catch those trends on the early stages. As we see the short and long bonds, they've been going down. So I definitely believe that we may have more power for the US dollar. Let me just sorry. All right, let's get So yes, the rate cut was done 25 basis points, and the reduction on the federal funds rate typically is a cooling off effect on the dollar, but it was pretty different, all right? Because lower interest decrease the appeal of a currency for international investors, as we call FOIs, FDI, sorry, foreign direct investors, who often are seeking higher yields as the US interest rates dropped, but the dollar did become more attractive, I would say, okay, just because of the Trump trade. And with the next topic we're going to be talking about of the tariffs. Okay, so we can have mixed impacts on the tariffs. We will talk about that later on. But on the positive side, this could somewhat weaken the US dollar. And if we weaken the US dollar, the American exports will be more competitive in the global market. So goods and services pricing on the US dollar will become more affordable abroad to other countries. So which will boost the demand for the US dollar products, and this will generate more GDP. So it's a higher GDP for the country. In some instance, yes, this will give some sort of strength because the economy is actually doing well. But when we have a softening US dollar, then not great, okay? Now, as the Fed say, the recent indicators suggest that economic activity has continued to expand at a solid pace, Since earlier in the year, the labor market conditions have generally eased and the unemployment rate has moved up, but remains low. Inflation has made progress towards the committee's 2% objective, but remains somewhat elevated. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. The committee judges that the risks to achieving its employment and inflation goals are roughly in balance. The economic outlook is uncertain, and the committee is attentive to the risks to both sides of its dual mandate. What are the dual mandates of the Fed? The first mandate is the labor market. The second mandate is the inflation. They have to bring inflation down as they are giving out more jobs, let's say, for the population, for the society, all right? And into support of these goals that I've just mentioned, the committee has decided to lower the target federal range to 1/4 percentage point to 4.5 to 4.75 in percent. So pretty much 425 to 450. Okay, so 450, 475, sorry. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee will continue reducing its holdings of treasury securities and agency debt and agency mortgage-backed securities. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. So that's pretty much all what the Fed has to be doing until inflation is on target. Now, that's pretty much it. We don't have any surprises, but I just want to come back to this area here and click on press conference. And then click on play. Let me share my audio with everyone as well. Let me just see where the audio. Let me stop share and share again. I can share the audio. Screen one, share sound. And perfect. Okay. I just want to very quickly and briefly touch base on one point here that one of the journalists have asked the German poll. Can you guys hear it? Is that right?
Good afternoon.
I think everyone can
My
hear.
colleagues and I remain squarely focused.
So you have put a marker at Jackson Hole saying
back to 2%.
Okay, there you go.
Pretty quickly to the that wage increases are now consistent with 2% inflation given current productivity readings. But of course, the lore on productivity readings is whenever you see high readings, you should assume they're going to revert pretty quickly to the longer-term trend. That has always been the case for 50 years. But, you know, it may be that we're now 5 years, if you look at the NIPA revisions that came out a month ago, we're 5 years into a nice set of productivity readings, which are sustained and very healthy. But overall, it's a good labor market. We could talk about 20 different data series. We'll be looking at all of them, of course. You know, we don't want the labor market to soften much from here. We don't think we need that to happen to get inflation back to 2%.
Perfect. So this is the part. This is already a hint where the next NFP will probably come in higher than the previous, of course. You know, it was 12,000. We can't expect this to be lower than that. But anyways, so most likely we will continue to see stronger US dollar from now on, especially because we will have a good employment market, as Jerome Powell has just said to us, and we will continue to see a Trump trade progressing towards the end of this year. Okay, so another point of longing US dollar. So that was pretty much it, what I want to show from this. And I think we can move to the next topic. So the Federal Reserve's rate cut decision, yes, 25 basis points cut. They've been somewhat data dependent to hawkish, and they will continue to maintain this approach towards the data dependent until inflation is back to target, and they is trying to mandate, and they're trying to control the inflation and bring inflation down while maintaining the dual mandate that is with a health labor market and bringing inflation down with no not stalling the economy. Okay. Now, second topic I want to talk about is the impact on fiscal stimulus on the US dollar and the euro dollar. Okay. So we have in front of us the DXY, right? And the DXY has been rising since 1st of October, right? There you go, 1st of October. It has been rising since 1st of October to now, 5.20, pretty much 29%, let's say 5.3% on 2 months, all right? 2 months, let's say 2 months. And that being very, very crazy. In my whole trading life, I've never seen DXY raising that much in like pretty much a month or so. So that's my first time looking at this like that. My target for the DXY is still at 106. Okay. So, well, with the Trump re-elected and backed by the Republican majority in Congress, there's a very, very strong support for a more aggressive fiscal approach. Okay. Basically, this means that we are likely to see significant spending initiatives, and this will boost the US dollar economic growth. And this will boost the US economic growth, which it can have a notable effect on the currently dynamics that we are looking at the market right now. So, first thing is substantial fiscal spending, such as the infrastructure projects, tax cuts, or even targeted stimulus for industries. It tends to drive drive up the economic activity, right? As the US dollar economy is showing some signs of strength, still showing some signs of strength. We having, as I just mentioned about Fed, the Fed continues to believe that we are on, well, not we, but USA is on a strong footpath to continue to have higher GDP. And investors around the globe are often interested in those types of countries, and they increase the demand for the US dollar denominated assets. Okay. This will most likely inflow of capital naturally will inflow the capital, and this will strengthen the US dollar. So for the US dollar, for the euro dollar, let me just open the chart here in FinLogix as well. There you go. That's a daily. Let's move to a 1 hour chart. Perfect. So for the euro dollar, it's the strengthening of the US dollar. It will lead to a sustained downward pressure, as we're seeing right now. And I would say that we won't have such things like that anymore, and nothing like those huge moves. But we will continue to have some slowly down, as we're having right now, scaling down, scaling down, just scaling down. Okay, especially as the Eurozone is facing their own sort of challenges, and Europe recession risks are becoming more prominent. I think with slowing the economic growth, they have the energy concerns as well. Very dovish ECB, European Central Bank, and the pretty much the divergence between economic trajectories between the US and the Eurozone makes the US dollar much more attractive for FDIs, for foreign direct investors, and it will further weight down on the euro dollar. So if we try to bring this in trading terms, it can probably create a very good setup for us to short the euro dollar. Maybe, if we wait for some sort of pullback, we've just had the break out of this bottom. So let's just do some technical here. So let's just count from this 33rd of October to now. We've seen the market breaking down this bottom. Okay. And we've seen this break as well. And that was pretty much it. When we see this sort of break here, we had this huge pullback. But you know what's funny? Because if we do a Fibonacci, very, very quick here, I don't want to lose too much time. This is only a 38.2% of a pullback. We didn't even get to 50% or 61.8%, right? So very, very interesting how the market is trading at the moment. I don't think we will have any sort of 61 pullback here. Most likely, we will continue to drive ourselves down to 106. From now to 106. So let me just... Perfect. So that's my target for this very, very short term. So for the very, very, very short term, most likely we will continue to see the euro dollar trending lower to 106. Okay. And if we see the 106 being break, then 105, and then 104, and then 102, 103, 2, and 1. That's my main target. 1, parity is the main target. Most likely we will see this to next year. But, okay, bear in mind that fiscal stimulus is, yes, it will likely strengthen the US dollar, and this will apply continued downward pressure on the euro dollar. But especially because the European is, with some sort of recession concerns and etc. But you need to understand that if anything goes wrong on US, then this trade is out of swept. It's clean. Okay. Because this only will work if this trade will only work if we continue to see that pressure from the US dollar into Trump trade. Okay. So I think that's pretty much it for the impact of the fiscal stimulus on the US dollar and the euro dollar. Now, the trading strategies for euro dollar, as we're saying, for the short term, end of this 2024, I'm going to be focusing on euro dollar shorts, short positions, because especially around the fiscal announcements, trade policies, and the inflation data. Like we have inflation data this week, are we shorting? Are we expecting the US dollar to have some sort of a little bit more higher inflation than what is actually, prominent to the market? But In the medium to long term, potentially for euro dollar longs, if the US dollar strength fades out. But we can't just, come here and say, look, this is what's going to happen. Most likely, the 106 level of DXY, as we've seen right now here, 106, we can probably continue. Let me just zoom in here. Just a second. So that 106 level on DXY is probably accountable of the 106 at euro dollar. So most likely we'll see DXY reaching 106 and euro dollar reaching 106. All right. I'm not saying just because the similar number. No, I'm just saying because it looks like the strength that it may need to get into 106 is the strength that needs to push the euro back down to 106, right? So that's pretty much what I think. Now, medium to long term, as I was saying, most likely, if we don't see the US dollar fade out, we will see a continuing strength of the euro dollar, of the US dollar. If we see the US dollar fade out, strength US dollar fades out, then we're looking to, I don't even know where we could potentially go, but looking at targets, we have a massive target just around here at 112. Okay. And that could potentially be a target for us, 1.12, market coming down to here, and next year going all the way up here. Okay. So if we moving into 2025, the outlook may shift, but for this year, yes, I'm definitely short on euro dollar, because next year the fiscal stimulus and the trade policies may take full effect, and we might see the US dollar upward momentum slow or even, stabilize or fade out from last week of December to January. And additionally, if the Fed responds to a maturing economic cycle by easing even more the policy in next month, if they, let's say, do a 50 basis point, it's not what they're planning to do, okay? Because they're planning to do only a 25 from 450 to 475 to 425, 550. But if they keep rates as unchanged, this will drag even more strength to the US dollar for this year until end of the year and end of December. Okay, so so the dollar, yes, could face downward pressure in the next year if we see the Fed being very, very dovish, where I don't think it will. Okay, I don't think it will, but everything can happen right now. I have a question regarding debt ceiling limits in US, which is on 1st January 2025. How it will affect the markets? That's a pretty good question, Satish. So basically, the debt ceiling is reached on January 1st, 2025. It could lead to significant market volatility, first of all, and most likely some economic concerns. The debt ceiling is pretty much, for those who don't know, is the maximum amount of that the US government is legally allowed to borrow to meet its financial obligations. So including paying for existing government programs, Social Security, Medicare. I don't know if it's even called Medicare in there, but whatever. In Australia is Medicare. Interest on the national debt. And yeah, I think that's pretty much it. So if the ceiling isn't raised, the government risks defaulting on its debt. So a scenario that this type of scenario has some really serious consequences for economic. And the first things are increased market volatility. So equities like stock markets could react with very, very big volatility, and the treasuries, the long and short yields. So the debt ceiling would create unusual volatility on the US Treasury market. So most likely yields on the short-term treasury bills may rise as the investors will seek more stability in the longer term, and because they will be fearing disruptions in the short-term government cash flow. So the second point, of course, is the credit rating downgrades. So if the US dollar approaches default or even experiences a sort of temporary default, the crediting rate of the agencies could downgrade because the US government will be, it won't be as before. So it will downgrade the credit. And this will, of course, raise the borrowing costs because the treasury yields would increase, and to compensate the higher perceived risk as they would be of downgraded the credit. And of course, it's going to be strengthening the safe haven asset. So the US dollar may strengthen, okay? I'm not talking about yes, it will or not, but it may strengthen in the sort of, safe haven asset class, because the investors will be seeking some shelter towards the reserve currencies, despite the US dollar being at the center of the uncertainty, let's say. The crisis will drag on, and the confidence in the dollar may erode, especially if the debt ceiling situation is reflecting the longer term fiscal instability. Okay, so I think Japanese yen as well, but that's pretty much it. What's your current look on Bitcoin considering the spike due to the winning of Trump in the US election? Wow, Matthias, that's a good question, man. The Bitcoin trade is right here on my side, right, Nathan? I don't know much about Bitcoin, so I can't tell you. I'm more into a boring sort of stuff, into macroeconomics. Sorry. So yeah, hopefully I've answered your question, Satish. Now, yeah, so pretty much trading strategies for euro dollar would be that. And now let's talk about gold. Last topic of the day. Okay, perfect. Is anyone trading gold? Is anyone long on gold? I wanna know that. No one trading gold. Wow. Okay. Okay. So gold, I have a very different view from maybe some of you have. But I do believe gold can continue to push lower if we break through this sort of support area here at 2,600. Just to make things easier, let's place in 2,600 so it's easier. There you go. So 2,600. If we see a break below 2,600, we may be looking to go to 2,500. Okay, that is right in the middle of this consolidation, as we all know. Let me just do the perfecto. Nice, done. So that's where I'm looking to go with gold, 2,500. Why is gold not bouncing back? That's the question I've been thinking about, and I've tried to understand as well. But let's take as this, all right? So let's say you are a big investor and you had been riding the wave of gold since $2,400, as it was beginning of this year, if I'm most, no, $2,000, sorry, it was in $2,000. Yeah, so you've been riding the wave of gold since $2,000. So 700, pretty much $800 gold has been increased, and you want to sell some positions because you feel like that Donald Trump in power right now will drag the US dollar down. So what you will do is you will get your money into some yields, short and long-term yields, and you will get this money on the actual physical US dollar. And this will, of course, majority of the people trading gold will execute out those positions, will buy out those positions, and will get to new opportunities into the market. So basically continue to drop the gold prices to 2,000, maybe 500, if we break the 2,600. Of course, we may have a, stop point at 2,560, 2,580, somewhere around those levels, but mainly looking to 2,500 is where I'm looking into gold. So I'm not expecting gold to have a pullback anytime soon, especially if the US dollar is, continues to strengthen and the Trump trade continues to exaggerates itself, let's say. Right? Aditya says GBP USD. Well, I'm going to be very honest with everyone here. I'm going to be very clear with everyone. Anything there is US dollar on the quote, I'm shorting. And if there is anything of US dollar on the base, I'm longing. GBP USD most likely coming down to this area here of 127. 127. Perfect. So 127 is the area I'm looking to drag down the GBP USD. Maybe we freshly break down this low here, 28,400, let's say. And now we're coming down to 27. Okay. That's pretty much my view on that. And between euro dollar and any other currency, like between euro dollar and GBP USD, most likely GBP USD will move further and faster than euro dollar. Okay, that's my view. So having positions on both is pretty good, but try to keep the same position. So short in one and short in another, as this is not categorized as a hedging. Otherwise, you would be losing in one and making money in another. All right, guys. So we come to an end. So we've done a pretty decent overview of the market as of today. We had a look at the economic calendar. We've talked about the federal rates cut decision. We've talked about the impact of fiscal stimulus on the US dollar and how this can impact the euro dollar and what's the strategy we can use that the fiscal stimulus is impacting the US dollar to trade the euro dollar short, and if I think that the gold will bounce back. Thank you so much, everyone. Hopefully we have Satish asked me a question, general question. How did you start trading? Oh, long time ago with a fund. Started on a fund, hedge fund. One of my friends. So yeah, guys, thank you so much. Hopefully everyone have a good week ahead, and I see everyone tomorrow. See you, sweets. Thanks, guys. Bye-bye.